What a great week. Thanks for joining us here on Retiring Well. We're going to be getting into why over half of retirees are now paying tax on their Social Security. Then we're going to dive into, should you be deferring your Social Security or waiting for tax reasons? Then, when do you need a will, or do you need a will? And then finally wrapping up with the kind of the saying, the tyranny of the or and the genius of the and. So stay tuned with all this information and more here on Retiring Well.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
So the question at hand is, why are half of retirees now paying taxes on their Social Security retirement benefits? So first we have to look at ultimately how is that calculated? So you're first looking at approximately half of your Social Security plus your adjusted gross income, which may include wages, interest, dividends, other taxable income, and that gets you to a figure. And you can go to ssa.gov to learn a whole lot more about how this is calculated and factored into things. But so you take that again, half of your Social Security plus your adjusted gross income, and you come up with this figure. Now, for 2021, for a married couple, if you're over $44,000, now 85% of your Social Security income is going to be considered taxable income. And if you're single taxpayer in 2021, if that figure ends up being over $34,000, now, again, you're at 85% of your Social Security will be considered taxable income. So we go way back to 1984 is when benefits became taxable, and it was then that these income tax brackets were factored in. And since that, think of that, it's nearly 40 years now, they have not adjusted for inflation. So here we are looking at tax tables that are based on 1984 versus where we stand today. So initially when this came out, a little less than 10% of retirees that were collecting their Social Security benefits were paying taxes on their Social Security income. Today, that looks like to be about over half of retirees that are drawing their Social Security benefits are now paying taxes. So again, it's something you want to be paying close attention to as far as how is all of your income structured? Are there any opportunities where you have maybe after-tax money that could be used that won't necessarily be showing up on the tax return and to keep those tax costs a little bit lower? So all these different areas that you'd want to be paying attention to when you're mapping out a long-term retirement income plan, and hopefully that you found this information valuable as you look to receive your Social Security retirement benefits.
Here at Centennial Wealth Advisory of Northern Michigan, we put together a weekly show, Retiring Well. This is for folks that are retired or soon to be retired and focusing on all things that may be pertinent to them at that time of their lives. So if you're interested in retirement income, retirement investments, tax planning, this is a great show for you, airing every week here in Northern Michigan. Learn more at cen-wealth.com or call the number on the screen.
Hi, my name is Jack Klunder, and I am a financial advisor with Centennial Wealth Advisory. I work out of our Cadillac office, and we specialize in retirement planning. We take a very holistic approach. We start with investments and see how you're situated there. We do wealth management. We do income planning. We do tax planning, any kind of healthcare issues or needs that you might have for insurance. And then we talk about what your legacy plan might be. So if you are nearing or in retirement and you have questions that you want to go over, please give the number on the screen a call, and we can have and set up a free, no obligation consultation.
When it comes to your financial future, what's the value of a truly objective opinion? As someone looking for financial guidance, you have choices. There are thousands of captive financial professionals who work as employees for large national insurance companies and brokerages. There are also many independent financial professionals who aren't bound to any given insurance company, investment strategy, or product. So what's the difference, and why does it really matter to you? Consider this. If you walked into a doctor's office with a sore throat, a bad cough, and a high fever, you'd expect that doctor to assess your symptoms, do a thorough diagnosis, and ultimately hand you a prescription written to cure your particular ailment. In other words, you'd expect the doctor to consider all the medications available and give you his or her absolute best thinking on what's best for you. On the other hand, if that doctor opened the cupboard and only had 3 or 4 prescriptions available, maybe those offered by his or her favorite pharmaceutical rep, most patients would immediately raise an eyebrow, suspicious that they might not be getting what was really in their best interest. The same may be true for your financial well-being. If your financial professional is an employee who's contractually bound to represent a given insurance or investment company, only offering their products while there are literally hundreds of others available, how sure can you be that you're being offered what's truly best for your situation? You don't walk into a tailor or seamstress shop to get clothing off some rack. You go for a custom-tailored fit. And with something as important as your financial future at hand, the stakes are even higher. We believe you deserve a truly objective opinion. We think you deserve to consider more of the available options. And we believe your financial future is worth a custom-tailored prescription to help you feel confident for the days ahead. If you'd like a second opinion on your current retirement strategy, simply contact our office today.
Welcome. In this segment, I want to talk to you about one reason that you might want to wait in taking Social Security. Now, there's a lot of factors that go into determining whether you should take it early or not, but I just want to give you one today that I want to focus on, and that's income taxes. Now, what I have here is I have a married couple. They're both age 62. They've decided to take Social Security early, okay? They're going to take a combined amount of almost $33,000 out. Now, they want $72,000 of income. So they're just going to take an additional $39,000 out of the IRA to make up the difference. Now, Uncle Sam says in this scenario, now it's kind of a complicated formula they go by to determining this, but basically they take half your Social Security, all your other income, and when you hit a couple different thresholds, it'll determine how much of your Social Security becomes taxable income. Now, I'm not going to go into great detail of that right now, but just understand that this couple taking almost $33,000 in Social Security, just about half of it is going to be taxable income. So then they get a standard deduction of $24,000. Their income tax in this particular case, or their taxable income, is $30,000, almost $31,000. Income tax, $3,330. Now, if they'd waited to age 70, okay, their Social Security benefits have grown, almost double what they would have been at age 62. In this particular case, if they waited to age 70, their combined Social Security would be almost $58,000. Now, they still want the same income of $72,000 at that time. So now, though, they only have to take $14,000 out of the IRA to make up the difference. Remember, back here they had $39,000. Now it's only $14,000. In this particular case, now Uncle Sam says out of that all that Social Security, only $5,528 of it is taxable income. Now, in this particular case, I got a little higher standard deduction because now they're older than age 65. But in this scenario, taxable income is zero. Income tax is zero. Now, how much tax do you want to be paying on your IRA money? I would dare say if I can get to the place where I can take money out of my IRA and not have to pay any tax at all, then that was a great scenario. Because remember, when I was putting money into those accounts, I was getting a tax deduction. Now, if I take out of those accounts and I'm not paying any tax, what could be better than that? Folks, again, there's a lot of different reasons why you might want to wait to take Social Security. This, again, was just one from an income tax standpoint, but very vitally important to understand.
Hey, welcome back. I hope that you found that segment valuable. You know, one of the things that we look at in retirement planning is what we would say is predictable contractual lifetime income. Social Security being one of those situations. And a couple of the numbers that really stood out to me was back in 1984, that when this was originally set up with the different income limits of how Social Security was going to get taxed, only 10% of the citizens were getting their Social Security taxed. Today, that rate is closer to like 50%. Why did that happen? Well, they haven't grown any of those income bracket limits, okay? So they're still using the numbers from 1984. If you're single and you make more than $25,000 a year, you're in taxable income, your Social Security is going to have now a tax component. You know, if you were to inflate those numbers, that should be closer to maybe $63,000 in today's dollars. Well, it's not, and that's a problem. But it's a problem that we want to work through because we want to have a plan behind that problem. And that's one of the good things that we get to do is we get to say, all right, when and how might your Social Security get taxed? Let's talk through the strategy behind what we want that to look like in your situation. And then, Nick, you had some specific examples.
Yeah. So I had a recent case where a couple came in and they wanted to know if they should take Social Security right away at age 62. And typically, you know, we're recommending for the average client, hey, you know what, it might be best to wait and have the higher of the two Social Securities, you delay that as long as possible to protect the surviving spouse. Well, in this case, based on their income, after doing some income planning, we realized that for them, based on their asset size and their IRAs, it made the most sense for them to both defer their Social Security to full retirement age because of RMDs later in life at age 72. Now, everybody's situation is unique, of course, but that is something where we can plug in all your numbers into this retirement analyzer program and show you what scenario might work best for your situation. Stay tuned. We're going to be talking about when do you need a will coming up next. Here at Centennial Wealth Advisory, we have multiple locations to serve Northern Michigan. My name is Nick Greenman. I'm located out of the Gaylord office, and I'd be happy to offer that second opinion on your retirement planning. We don't just cover investments here at Centennial Wealth Advisory. We cover the whole retirement picture. So we're talking investments, tax planning, income planning, Social Security planning, health insurance, that holistic approach. So please, if you're looking for that free, no obligation consultation, give us a call at the number on the screen.
What can Retirement Analyzer do for you? Retirement Analyzer is a software tool that can help you prepare today for your financial future. You've worked hard to save for your retirement, but as you near your retirement, you may have concerns. Have I positioned my retirement savings wisely? Have I saved enough for retirement? And will my savings last throughout my lifetime? What impact could inflation have on my future expenses? What if I suffer a long-term illness? Will I have enough money to cover my medical care expenses and still be able to meet my other financial obligations? Could changes in the income tax rates disrupt my retirement strategy? There's no need to be in the dark as you prepare for your retirement. Retirement Analyzer can help you find answers to all these questions and more. The first step is providing us with information on your financial assets, the type and current value of those assets, as well as your sources of income. Then, we work with you to identify your expected expenses in retirement. This will include a discussion of the lifestyle you envision in retirement, travel, a summer residence, whatever you dream your retirement will be. We'll input the information you provide us into the Retirement Analyzer, and in a very short time we'll have reports that show us the percentage of assets currently in high-risk vehicles as well as the percent in lower-risk products. Retirement Analyzer enables us to project your income from year to year in your retirement and see how long your retirement savings may last. As we change the conditions of the report, delaying your retirement date, including costs for long-term care, adjusting the expected tax rate, or adjusting your retirement strategies, we can see how changes in these variables may impact your income in retirement and the longevity of your retirement savings. Let the Retirement Analyzer help you test drive your retirement strategy today, because the time to discover the bumps in the road is not once your trip through retirement has begun. Contact our office today to schedule an appointment for your Retirement Analyzer review.
I'm going to pose a question today on this segment, and it's, when do you need a will? I'm not an estate planning attorney here, full disclosure, financial planner, financial advisor here, but we work with folks and work with conjunction with estate planning attorneys all the time. So when do you need a will? You know, the question is, well, when I pass away, right? Likely don't need one before that for any reason, but since we all don't know when that day may be, it's important to plan in advance, right? So let's walk through some of the things from an asset. So, you know, one of the estate planners we work with, I think, does this really great illustration, and he has this, you know, bucket of candy. Let's envision that, and there's all these pieces of candy inside of that. And the question is when you pass away, where do all these things, these pieces of candy, need to go to, right? So if you dump that candy bucket out, you've passed away, and there's all these assets, all this candy spread all over the table, where does each piece need to go? Well, some things are going to have beneficiary designations on them. Hopefully your investments have done that, maybe payable on death through your bank accounts, things that you can name direct beneficiaries to. Those are going to supersede that will or trust anyway. So make sure that you have up-to-date 401k beneficiary designations, IRAs, Roth, any investment account. Double check those every year at least to make sure they're correctly going to you, and that if somebody maybe already hasn't predeceased you that's on there, or maybe there's an ex-spouse or something like that, maybe making sure you know where you want it to go, okay? So then that takes care of some of our candy on the table in that illustration, right? What about the rest of the pieces? Well, maybe there's a home in there or other properties. How does that know where to go? Well, there's maybe ladybird deeds, maybe there's trust, some stuff there that often gets left behind. Maybe there's another owner on the property. So making sure, once again, if you're gone, where does that piece of candy, that property, need to go to in that illustration? Okay, so we got a few more pieces of candy off the table. What's left? Well, maybe personal possessions. Think of vehicles, boats, motorhomes, all that stuff that people tend to have. Well, there's titles on those, but still it's got to know where to go, right? So that might be something that either A, has to be done through a trust, maybe through a will. Secretary of State has a form that you can claim that sort of stuff, but it's got to know where to go. What about all the cups in the cupboard and the guns in the gun safe and the collectibles under the china cabinet, stuff like that? Well, where does that go? Sometimes those are things that have to be listed out in that will so people know what to do with your possessions when you're gone. So a will is typically read by a probate court attorney, or I'm sorry, probate court judge, in looking where your wishes are, where these assets want to go. So it's really important for you to make sure you're telling your story, right? Otherwise, it's left for the interpretation of survivors, the probate courts, to figure out what to do with your assets. So commonly, most people would want a will. Maybe not everybody, but in most cases, you would want one. So, you know, for you out there, this is something that's not fun to do. You're planning for your death, right? So get that, take that first step. Give us a call. We'll help you set that up for you. Work with a trusted estate planning attorneys in town here and make sure you're covered so your assets know where to go.
Welcome back. Lots of great information there on when do you need a will. Great example of this, we had a couple come in and they had really just verbal agreements with their kids as far as what assets they were going to get. In particular, this gentleman had a 67 Mustang, a 32-foot boat, and then he also had some antique guns and then some newer guns, and he wanted to give each asset to a different child based on what he thought they could use the most, right? One of the kids was more of a gearhead, a car guy. The other gentleman was more of a boater, and the other gentleman was a hunter. So he thought, you know what, just a verbal agreement would be fine. And it could be, okay, but you want to make sure that your wishes are actually carried through. Not saying that your kids wouldn't follow your wishes, but it's always a good thing to have that written down, and that's where a will would come into play. So we encourage them, hey, write this down in your will. Say, hey, this son gets that 67 Mustang and this son gets that boat, and so forth. Just so that when you do pass away, you don't leave any headaches for your beneficiaries or your children and your family after that time does come.
Yeah, you know, one thing that we also find a lot of times is clients will come in and we'll go into that estate planning conversation, and we'll say, you know, do you have any of those documents in place? And they might say, yeah, I have a will. It's from 1999. And we say, okay, has life changed since 1999? Yeah. Okay, well, let's look at that. Let's maybe update that will. Let's see if, do you need some power of attorneys in place for your health care, for your financial statements, bank accounts, things like that? Do you need a trust? You know, we just look at that in your current situation, and we have a couple different law firms that we work with that have specialized in estate planning needs. And so if you have any questions, or if you have any concerns, or if you just want to come get a second opinion on where your estate plan is currently situated, let us know. Give us a call. So stay tuned for the next segment, where we get to talk about the tyranny of the or and the genius of the and.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
Here at Centennial Wealth Advisory of Northern Michigan, we put together a weekly show, Retiring Well. This is for folks that are retired or soon to be retired and focusing on all things that may be pertinent to them at that time of their lives. So if you're interested in retirement income, retirement investments, tax planning, this is a great show for you, airing every week here in Northern Michigan. Learn more at cen-wealth.com or call the number on the screen.
Hi, listen, in this segment, I want to talk to you about something I read a long time ago. It was in a book called Built to Last by Jim Collins. He talks about these 18 companies that have been around forever and how they literally were able to transform themselves and last the test of time. He followed with a book called Good to Great. But in that first book, there's a chapter called The Tyranny of the Or and the Genius of the And. Quite interesting. He showed how companies that embraced this philosophy, that it's not an either or, sometimes you can have both, those that embraced that had success. You know, it takes things like, a purpose or profit, right? How about freedom and responsibility? How about discipline and creativity? All right, and he talks about how these companies can take those paradoxes and find the genius in the end and find a way to have both. Now, this applies in the investment world as well, and I just want to give you some examples. I consume a lot of investment news. I do it because I want to be on top of things. I want to be there for my clients. But you got to understand, this news, there's people on both sides. You know, you got what they call the perma bulls. They're always going to find a reason to talk about how the market's going to do well, right, no matter what. And then you got the other side of the spectrum. It's the doom and gloom and how things are going to all fall apart tomorrow. And and it's consuming a lot of this financial information and being able to find that golden nugget, that truth that basically is usually in the middle. Okay, and then I find when we're meeting with clients, might be the first time, they have some assets, and one of the things they get trapped into thinking is that I got to either leave my advisor and I got to maybe go with you guys. They get caught in this either or trap. a lot of times I'll just point out to them, it doesn't hurt to have, 2 advisors. Maybe you bring some assets over with us and you see how we operate, see if we can, you build some trust over time. If you find you like us and we're a good fit for you, then maybe we can talk about maybe moving some more. But, let's get a relationship started. So you can find it in that. Find it when we look at investment instruments themselves. People want, they want growth, but they also want safety, right? Especially if they're getting near retirement. So, trying to find, that balance for them, maybe, showing them some products that maybe are a hybrid where they can have the growth and a little bit of the safety as well. So we find it in that. We find it in what we call the fiduciary standard of care. That's where advisors have to act in the best interests of their clients. Well, how do they balance that with the fact that, they're also a business, they need to make money. So, I find that the integrity of making sure that you put the client's interest first really works out in the long run, because usually that model of integrity will bring more client referrals, maybe additional assets that they have because you've built a trust with them, and then it just creates a good corporate culture, when you have that kind of integrity. So listen, we live in a very polarizing world, but it doesn't have to be that way with your retirement plan or your assets. So if we could be of help or talk to you more about that, give us a call.
What an interesting topic there that Larry was talking about, the tyranny of the or and the genius of the and. What really stuck out to me in what was one of his comments where he mentioned that, some people think that when they roll over their new money or their money to a new advisor, they have to roll everything, and that's just not the case. Okay, that's the tyranny of the or. Do you have either or advisor? No, it can be both. You can have one advisor doing one thing and another advisor doing something else. And we have this all the time. And just recently I had a client join on, and he didn't move over all of his assets, but one thing that we as a firm want to make sure that we understand is what that other advisor is accomplishing with that portion of your assets, so that when we go out there and we're going to accomplish a different goal. In this case, he had one advisor managing the growth aspect of his portfolio. So they were going out there trying to capture as much growth as possible on that side, and on our side, we were being more risk adverse. We were being more conservative. And that is just something where we would work together. I'd want to know, hey, what's that other advisor doing, so we don't have any duplication going on in your portfolio. And that's kind of the beauty of the genius of the and.
Absolutely. We find that a lot where there might be one spouse that has retired and another spouse is still working with their 401k plan and doesn't even have the option to roll over yet. And like Nick is saying, okay, how does that portion of that portfolio fit into your overall plan? And that's why I love doing this job. We get to plan. We get to do another genius of the and, which is to be a financial advisor and educate. That's powerful. You learn what you have as options. We get to teach. Dave Ramsey always said, hey, find an advisor that has the heart of a teacher. And so continually educating, continually adding value is something that we love and we always are going to strive to do for you. As you understand your plan, you understand why you're doing what you're doing, why you're positioned the way that you are, there's a different piece that comes through planning. So if you have any questions or any concerns, or if you want to have that free, no obligation consultation with us, please give the call the number on your screen. Thanks again for tuning in this week to this episode. We hope you found a lot of value in it, and we'll see you next week. Same time, same channel.